I think a fundamental concept that people should learn about in terms of portfolio construction is not about the individual players, it's how they work as a team. But if Lionel Messi was the best footballer in the world, some people might conclude that a team with 11 Lionel Messis would be world champion. I would much rather have 10 Lionel Messis and a Thibaut Courtois, the Real Madrid goalkeeper, than Messi on goal. So it's about what positions do you have in your portfolio and who are the right players to fill that role.
Hello and welcome to the Achieving Alpha podcast. My name is Stephen and I am the host of the show. Today, I'm delighted to be joined by Diego Parrilla. He is the Chief Investment Officer at Quadriga. In addition to that, he is also a visiting lecturer at the Imperial College of London, and he is the famous author of the book, The Anti-Bubbles. Welcome to the show, Diego. Really great to have you on.
Thank you so much, Steve. My pleasure.
So, how is things in Spain today?
It's surprisingly warm. So we're in the high 20s, which for September is not that usual, but the tail end of the summer.
It's really great to have you on today. I'm really looking forward to a really in-depth discussion with you on a number of different topics. There's a lots of stuff going on at the moment, so we won't have a shortage of subjects to talk about. And as your very first time on the podcast, I wanted to get a bit of a background into you and what you have done previously in your investing and in your finance experience.
So originally from Spain. I'm a mining and petroleum engineer. Did my master's in mineral economics at the Colorado School of Mines and the French Institute of Petroleum. I did my thesis in something called real options, which values real assets using option theory. It's a side note, a lettuce is a call option on a salad, as one of my professors said. And options really have marked my career. Started at trading in the mid-late 90s in London with JP Morgan. Then I was with Goldman Sachs and Merrill Lynch in the commodities and FX macro business. I then moved on to the buy side with my own firm and some large hedge funds like Bluecrest and Diamond Asia that was in London, New York, Singapore. Before I moved back to Spain about 7 years ago, where I've been managing partner at Quadriga Asset Managers, and where I manage some of the defensive mandates, so macro, volatility, tail risk, commodities. In addition to my experience on the buy side, on the sell side, as you mentioned, I've written a couple of books. The Energy World is Flat and The Anti-Bubbles. And I'm a keen learner. And as such, Cicero wisely told us that if you want to learn, teach. And so I'm very honored to be teaching at Imperial College in London and regularly write and publish articles. And I've been lucky to publish 2 inside columns in the Financial Times, one of them in the front page. And this is all part of my humble effort to try to understand my own thoughts and put them in writing. And hopefully those are being helpful to other people. And I'm not super active, but I do have Twitter-X account and where I occasionally comment on markets and LinkedIn. So that's brief on an intro. And I live between London and Madrid.
Great. And I think it's really good that you pass your experience on to the next generation as well as collecting your own thoughts. I think that's a really noble endeavor as well. Did you always want to be in investing and finance? Because you mentioned that you were training him to be an engineer at the beginning.
Yeah, to be honest, it was never really the plan. I was an engineer, very much looking to go into that side. But my father was an engineer and economist. I understood that mix was also very powerful. And that's why I pursued my master's in mineral economics, but more from the perspective of the two worlds, economics, finance, but not so much from the investment or trading. That's something that happened. I think your first job is possibly equal or almost as important of what you study. It marks you in a number of ways. And for me, yeah, I landed in a phenomenal place with an incredible opportunity at an incredible time with JP Morgan and commodity 90s. And that was a fascinating time. It was $10 oil, it was $250 gold, a very different setup. And I think that was an incredible school to then move on into other fields of investing, such as foreign exchange and rates and volatility, and eventually portfolio management as such. But it's been a journey, a lot of fun. And I think at the end of the day, as risk managers and financial engineers, I think many of the skills that we learn in engineering are incredibly applicable. In some ways, coming in as a bit of an outsider, in some ways, as an engineer, I think it forces you or allows you to challenge certain things and do things slightly differently. And so I've always been very keen to understand the way things work and why they do. And that's in some ways helped me develop these frameworks that I present in the books and be very contrarian in terms of how things actually work. And so that's been a phenomenal journey. And I think everything's been contributing to what has been so far an extremely fun and, you know, environment and challenge, which I continue to enjoy. And hopefully I'll continue to do for a long time alongside my passion for teaching, which, as you mentioned, I think passing to the next generation to be able to contribute and share our experience and to the new generations is, I think, a big part of what drives me.
And I do think investing and engineering does have some parallels as well, like you mentioned, because a lot of it is process driven processes in investing and in engineering. It's a good skill to have, I think, if you're becoming an investor. Great. Before we launch into topics more about the macro environment and what's happening in the market, obviously you wrote a book called The Anti-Bubbles. I thought it'd be good to, first of all, define what are anti-bubbles. And if you could give some examples of anti-bubbles. And then from there, we can then dig into more about what's happening in the economy.
Sure. So in order to define anti-bubbles, I like to start by borrowing George Soros' definition of a bubble. And he defines bubbles as assets that are artificially expensive based on misconception. So effectively a false belief. And in that sense, the key word, in my opinion, is artificial. You have a construct that it's a matter of when, not if, that will eventually implode. So what I did is I generalized the framework, again, with my engineering mindset, is like understanding that misconceptions can distort reality, but not only through artificially high valuations, you could also create artificially low valuation. And so the first dimension of the concept of anti-bubble is assets that are effectively artificially cheap. It's a matter of when, not if, that the valuation will implode higher. And in that sense, you could think of anti-bubbles as extreme value investments. So many of the listeners might be equity value driven. This is a pretty extreme form of value. The second dimension of the concept is that bubbles and anti-bubbles are like distorted mirror images of each other. Basically, given one misconception, you're going to create these two mirror images. And by construction, the moment the misconception is understood and the bubble bursts is the exact same instant that the catalyst, that the anti-bubble reflects, because they're effectively the same process. So I called it anti-bubble, a bit like an antivirus or an anti-missile is a defense mechanism against the bubble. And the third dimension is there's an element of reflexivity, of reflexive premia, reflexivity being two-way causality. So effectively, what is that? And I'll give you an example. If you think about the relationship between the S&P and the VIX, i.e. equity valuations, risk assets, and volatility, there's this inverse relationship by construction where settings of artificially low volatility can contribute to artificially high valuations and vice versa. Artificially high valuation, artificially high volatility could result in artificially low valuations. This is commonly associated with complacency and panic. We've seen it through periods of crisis. And what effectively drives this, and is very important to understand, is both qualitative and quantitative drivers that effectively build this relationship. Qualitatively, we have that complacency, the perception that there's no risk, the idea that mommy and daddy, central banks and governments will always be there to protect us and to save us, and that you can take a lot of risk without being penalized for that. Quantitatively, and we saw earlier last month in Japan, you have processes whereby when volatility is artificially low and that creates leverage in the system, you might have strategies like trend following or risk parity or volatility target that effectively, as volatility goes down, they lever themselves up. And when volatility explodes, that creates this automatic forced deleveraging. So this vicious and virtuous cycles of bubbles and anti-bubbles create effectively this dynamic over time. And I'd conclude the definition and the examples by saying that there's no good guy and bad guy in this movie. Sometimes equities are cheap, sometimes they're expensive. Sometimes volatility is cheap, sometimes it's expensive. What it's interesting is that they tend to be at exactly the opposite time. So having and being able to identify bubble, anti-bubble relationships allows us to build portfolios that effectively have these counterbalancing forces, where if you are able to accumulate and monetize in a counter-cyclical way, i.e. buy cheap, sell expensive, and sell expensive, buy cheap, this could be, and it's what we do, effectively a way to create portfolios that are, using a football analogy, have strikers, have defenders, and they play very well as a team. So this is, again, the concept of anti-bubble. In the book, I talk a lot about the macro implications and what are the beliefs and misconceptions and the bubbles, anti-bubbles in the system. But as a very direct application, this has also other uses such as portfolio construction and asset allocation and individual investments.
Yeah, that's a very good summary. And I think if bubbles are driven probably by greed, whereas anti bubbles are probably driven by fear. And that's probably what provides that dislocation in prices of what's required. I think people know a lot about bubbles in history. There's probably a lot of examples about bubbles in history. However, I think people probably know a little bit less about anti bubbles, things that particularly in history where they were very underpriced compared to what they should have been. Could you give just a couple of examples of anti bubbles in history and how they played out?
Yeah, great question. I think I would start by saying that show me the misconception, and then I'll tell you what the bubble and anti-bubble is, right? In my book, I permanently talk about gold being the anti-bubble of the fiat currency bubble. So these relationships where I think they're playing out in front of our eyes. We can think of many others, but just pops in my head during the dot-com crisis or bubble. Actually, a friend of mine went bankrupt because he owned cinemas. And at that time, there was the perception that with the dot-com and things like Netflix, no one would go back to a cinema. Why would you? Obviously, many years later, the world has changed, but clearly cinemas still exist. In fact, they've become a fantastic place for different purposes as well. But you could see those scenarios when the market goes from extremes. Another example would be associated to fraud. So it's not just greed and fear; it's just what makes something artificial. So take, for example, medicine or a new medical technique that it's supposed to cure some sort of illness, like cancer or whatever. If the minute that walks in and it creates these incredibly high valuations, it's also displacing the old regime. So if it turns out that this medicine or this method was actually a fraud, then what is obviously the expectations go or the valuations go to zero and the other thing normalizes. And I think this idea of whatever drives the artificial nature, the artificial setting, is it greed versus fear? Is it true or false? Beliefs versus misconceptions? And perhaps what makes things very complicated is exactly that trade-off, that dawn, that space of that Soros talks about, where beliefs and misconceptions live together, coexist. And So in some ways, when you have a new technology, and we're now in the midst of artificial intelligence, it's clearly a game changer technology. There's no question that there's a before and after. At the same time, some of these technologies that are thought to be game changers, let's say blockchain or crypto or any type of energy sources or quantum computer, whatever you want, any new disruptive technology will have people who think this is a true game changer, and there'll be people who say, no, this is not. And only time will tell. But in that process, you get this, fight between, is it a belief? Is it a misconception? But even if it's true, then you go into your point earlier on greed and excessive valuations, which effectively can lead to overcapacity and many processes that we discussed in the energy book and others. So it is a fascinating dynamic in the ultimate search for truth. And the markets are desperately trying to do their best to figure out whether is this a real game changer? Is it a misconception? And are we anywhere near that eternal search for fair value, which is very elusive as things continue to change? As we were wisely taught, the only and permanent thing is change. So I think Heraclitus said that. So I think in that sense, you get this very dynamic nature around life and around markets that can result in these major locations. Sometimes they stay and they become game changers. Sometimes they don't and they become bubbles.
Yeah, I've had this discussion on quite a few episodes of the podcast so far to do with AI and whether it's potentially a bubble. And a lot of people that I've spoken to have said it's not a normal bubble that you would see because there's a lot of revenues and good earnings attached to it. But as you said, it doesn't, just because something's inflated in terms of valuation doesn't always necessarily mean it's a full out bubble, right?
Absolutely. I think, again, look for the misconception and that will tell you where the bubble and anti-bubble is. If the misconception is related to adoption or prices that people will pay or competition, this is, I think, where the source of the bubble comes. Obviously, ChatGPT is a game changer, but I suspect we're going to have 10 different types of, at least every single major firm is going to have their own. Eventually, we're going to have our own LLMs in our own phones. And so to what extent the world is extrapolating in a linear fashion, whether it's adoption or revenues or growth on the one hand, and on the other hand, completely dismissing competition and overcapacity. And I think the bubbles are that intersection between them. It's the huge expectations that effectively create this magnet of money going into certain sectors that eventually leads to overcapacity and lower prices and lower valuations, and also creates anti-bubbles because as money flows in one sector, you're ignoring other sectors. And this is being viewed before. A good friend, Jeff Carey, published this great paper called The Revenge of the Old Economy. And that, I think it shows you those dynamics where suddenly money flows into just one sector away from others. The other thing that is fascinating about bubbles is that we tend to, bubbles have a bad name. You think about .com, those of us who lived it in firsthand, and it was like, oh, people were a bit scarred from it. But if you read The World is Flat by Thomas Friedman, which was a fantastic postmortem of the .com, which inspired my first book, The Energy World is Flat. I think one of the lessons was that bubbles in some ways create this game changer technology. You have all this money flowing in, this overcapacity, and eventually the valuations collapse and this game changer technology is available in huge size for free, as it was the case with broadband. And so only the bubbles were actually accelerating the impact and the adoption. So the positive side is, what should have taken way longer, these bubbles created this huge acceleration. And you can see that now with AI, right? So all these huge multi-billion, trillion valuations mean that the amount of investment and effort that is going there is just so brutal, right? And we're doing it thinking that we are in an exponential phase, every technology follows an S curve, right? Every single one. At the same time, I think we're building S curves on top of S curves on top of S curves, which means that we are truly exponential. But we have to keep that perspective that on the one hand, the linear of the revenue, and on the other hand, the linear, but in this case, completely passive expectation of competition are potentially resulting in these huge valuations, which again, is not all that bad because it will create this incredible amount of technology and productivity in the system. I don't think it's a zero-sum game. I think overall some money will be made or lost, but ultimately the productivity gains are additive. So in that sense, you might have a bubble in certain pockets, but the world is a better place.
Yeah. Yep. I totally agree with you on that. Okay. And I wanted to dig into the macro picture now. I thought if we could start off, if you could give me your broad strokes view on the macro economy at the moment. And then from there, we can then dig into each individual area.
Look, I think going back to the anti-bubbles, perhaps from a very big picture, I would say that the from a game theory perspective, we believe in there are two major misconceptions, which are really one, that are driving a lot of the macro. And they have done it and they will continue, which is every time we have a problem, we tend to uh, resolve it by printing money and increasing debt. Put differently, there's this belief that monetary and fiscal policies can solve problems. I think this is gross misconception. Monetary and fiscal policies do not solve problems. They do four things. The first thing they do is they delay the problem. We're effectively kicking the can down the road. We are spending and borrowing our way out of trouble. The second thing that's happening is we're transferring the problem. So through currency wars and trade wars, these are bigger than neighbor dynamics which are effectively feed on each other. So monetary policy is contagious. The only reason we had negative nominal interest rates in Europe was because the Fed was at zero. So we wanted to have a weaker euro and export our way out, et cetera, et cetera. Yeah. And the third thing that happens is we are transforming the problem. So by printing money, you might be in some ways transferring a credit problem or an energy problem into inflation. And inflation is really a monetary phenomenon. It's about the dilution of the purchase power of money. It's not about the value of oil going up. It's about the value of the dollars or euros or yen or yuan with which you pay that oil going down. And unfortunately, this transformation of problems into inflation tend to go hand in hand with inequality, social unrest, populism, and wars and geopolitics. The fourth thing that happens is that it's not a zero-sum game. Unfortunately, that printing and taking debt actually increases the problem, doesn't reduce it. So think about Argentina or Venezuela or Zimbabwe or who knows, Japan, China, Europe. The abuse of monetary and fiscal policies eventually results in bigger problems. You're giving up in monetary policy. You're effectively being forced to print more money to be able to borrow left pocket, left right pocket type of dynamics. And this happens in ways that things accelerate. So from a very big picture perspective, I think the system is wired and set up to end up with stagflation. That's the end game. And it happens because governments and central banks are not independent. Faced with a pandemic or a war or some sort of crisis, the governments will actually instruct those central banks, appointed the people in charge, and will claim these emergency measures are needed so that that money is being printed. And again, we are kicking the can, transforming, and enlarging problems. And this is a snowball that continues to grow. I think we're now at a tipping point where some of these bluffs have been called. We've seen Japan, I think, as one of the perhaps front leaders in monetary and fiscal abuse, starting to see, what it means for the yen, for rates, for many things. And ultimately, 2 plus 2 is 4. But when these things break, they can actually accelerate. And trying to just print and borrow your way out might look like it's solving problems, but in reality, it's not. So I think that is very much what's happening and what's been happening for the past few decades. We could go pretty much case by case with any country, any circumstances, from the Russia-Ukraine war and the energy crisis to the pandemic to regional banks blowing up in the US. And every single time we're doing the same thing. We are effectively printing and borrowing our way out and delaying, transferring, transforming, and enlarging those problems. That's where I see we're going. And when I dedicate my book, I always say, I hope you like it. I hope I'm wrong, because I do feel a bit like a doctor that is diagnosing a terrible disease to a friend. As a friend, I want to be wrong. As a doctor, I want to be correct. But I don't like the diagnosis that I'm coming up with. And I really sincerely hope I'm wrong.
Yeah, we all hope for a good world. I was going to mention as well, you talked about stagflation, and that's usually the end outcome of abuse of monetary policy over a long period of time. I know you don't have a crystal ball where you can predict time zones, but how long does it usually take for, after years of misuse of monetary policy, how long does that take usually to filter its way into stagflation in an economy?
Look, I think as with bubbles and anti-bubbles and others, I think the saying goes that bubbles can go for way longer and go way higher than anybody expected, but they also collapse and faster and deeper than anybody thought. So in some ways, it's the complacency that accumulates for decades, and then these things can happen very fast. I don't think it will be. I think this is happening in chapters, and each country has their own movie, and there are domino effects. So whilst you might think that Japan blowing up might be a very idiosyncratic issue, it would definitely have implications to others, whether Japan is forced to repatriate money or do some sort of defense mechanism to try to contain things. It could have an impact on selling of US treasuries and yields in the dollar market. So I think whilst these things can look, again, that it could take a long time and nobody sees them coming, they can happen very fast. So at the same time, the little mice are learning their way around the maze. And so you see that central banks and governments are faster and faster and reacting to these things. Think about the .com, or think about the '08, or think about the pandemic. We keep breaking these limits of how much we print and how fast. And in some ways, the bigger the crisis and the more deflation you have, the more you can print to just stand still. You need to run even faster. It's like the running tape is going, and then you're really running really fast to stand still. So from the outside, it might look that there's no inflation and things are stable, but the reality is that containing an implosion of the system by printing money, it's like filling a hole with paper. When it rains, there's nothing really there. So I think those imbalances are happening. Some of the bluffs have been called. Ultimately, the problem is so large that we'll continue to see this process. And I think the ultimate degree of freedom of the system, it's always the currency. It's always what gives. You could try to do whatever you want with taxes or expropriation or anything you want. But ultimately, I think it's the fiat currency and inflation, which go hand in hand, is the path by which some of these imbalances show up. So Japan has seen it. I think there'll be others who follow. But the flip side of that in the currency world is you get safe haven currencies, like the dollar is doing exactly the same issue or same practice. Then it might give you the perception that things are stable, but in reality, things like gold or real estate or real assets are telling you a different story. And this is why I think stagflation is the case, because you get this, uh, you know, relentless amount of printing and borrowing that is needed just to stand still, when in reality, your purchase power and your ability, we should not confuse inflation with purchase power. You are different things, but the reality is that we're being diluted. And that's why I use this analogy of the frogs in boiling water. We are all frogs in this monetary broth that where the temperatures officially, theoretically, increasing at 2 degrees or 2% per annum. The reality is the temperature is increasing way faster than 2%. So real inflation is much greater than official inflation. Inflation is not just one number. Your inflation basket might be different from mine. Maybe you have some people listen to us and babies with nappies. I have university fees. We have different baskets. But this is, I think, the way the system is going. And I think some of those bluffs are being called. And yeah, we'll see. We're getting into an interesting phase. And the next decade, I think, is going to be very interesting. And the Chinese saying, may you live in interesting times. So let's see what happens. There are lots of positives, but there are also tons of things that are structural that could come up. And we'll see how we can handle them.
All right. And I heard you mention in a past interview, I think it was over a year ago now, when they were increasing the interest rates, you mentioned that they were probably going to increase those interest rates until something broke in the system or something was breaking in the system. So there's obviously a lot of rumors. It's basically priced in now that in September FOMC meeting, they're likely to decrease the interest rates either by 0.25% or 0.5%, depending on which one you believe. So, what has started to break or what has broken to drive that decision to reduce those interest rates now rather than before?
I guess you could many reasons, but I think what you've seen is there's a clear realization that given the level of debt outstanding in the system, there's a limit of how much you can pay for that debt. So Europe effectively lagged the US on the way up, and it's leading on the way down. So Europe has already started the cutting cycle, right? And things start to break in terms of growth. They start to break in terms of different pockets. But I must say, it's been quite surprising, but in a good way, how resilient the system has been to these higher interest rates. It has coincided with other things like this major productivity and AI and other things. So in some ways, the wealth effect, the fact that the valuation of something, let's say, for lack of a better example, Bitcoin or whatever, the wealth effect associated with people feeling rich, what the real value of that crypto is, time will tell. But wealth effect, it's a double-edged sword. So they're very important part of bubbles in the virtuous cycle that as valuations increase, you feel richer, you spend more, etc. And that sort of comes up and bites you big time in the vicious cycle. When things are going down, you feel poorer and you spend less. So I think in that sense, we reached the level where interest rates could start breaking things in a bigger way. It's also gone to a level where it forced people like Japan to start hiking. So the back was against the wall. And you see what happened with a 15 basis point price increase. It's a bit of a joke. We're also coming from a world of negative interest rates in Europe. We're also working in a world where yield curve control is still de facto in place, with the ability for central banks to print money and contain long-term yields. So there are a lot of things out there that are double-edged swords. I think, to summarize, the central banks will, in this frog analogy, they will try to print as much as they possibly can get away with, as much money and as fast as they can, as long as the frogs are in the broth. Once inflation starts to show up and frogs start to jump because inflation is too high or inflation expectations are too high, then they have no choice but to react. And that's why we saw the most aggressive reaction in history in terms of hiking cycle because they completely overdid it. And now there's this perception that we've won the battle on inflation, which is true and false. I think the real inflation comes from structural money printing and debt. The system will need more, not less. But from a cyclical perspective, some of the bottlenecks in the system, some other things have eased. And so again, central banks will use this excuse to do anything they can. It's an election year. There are really tons of things that are playing into the case for cuts. It's probably, I think, 25 basis points is probably a reasonable assumption. I think 50 pips would come if things deteriorate dramatically on the market side. And as I said, mommy and daddy are proving that they're reacting faster and larger in anticipation, because as you build these imbalances, things can go belly up very fast. Remember the LDI crisis in the UK when it's a bit like, always reminds me of Mike Tyson. Politicians, they know what they need to do. They come with a plan and then the market punches them in the face. And then they need to completely unwind and say, no, of course, we're going to print money and support the fixed income market. I mean, so I think this is, again, central banks will try to always print as much as they can, keep rates as low as they can, borrow as much as they can. And there are things on the other side that will keeping them in check, but ultimately the trend is intact. So they will continue to try to do that. And if inflation resurfaces as a problem because of war, geopolitics, or other type of pressure, then they have to react. But for the time being, the narrative has changed to we've kind of won on inflation. We want to be early and fight potential deceleration of the economy. And in turn, the reduction of rates in the dollar takes some pressure off people like Japan or China and others that were in a much more difficult situation. So it's a fascinating, back to the engineering side, all these pieces I think are very clear in my head how they interact. And in some ways it's a complex dynamic, but yeah, they are short-term, medium, long-term dynamics. We'll see how, if they manage to continue to hold things in such a stable way, or things start to become more volatile, and that exposes some of the structural imbalances, which I think it's the more likely scenario.
Yeah. It's that Fed battle, isn't it, between keeping unemployment low and ensuring that inflation doesn't run out of control as well. So it's that age-old battle that's occurring, and maybe they've won the battle, but with inflation, but maybe not the overall war, right? With inflation. So is your overview, your long-term view, is it that we're probably going to have structurally higher inflation for longer over the long term?
Absolutely. Yeah, I think, again, it goes back to the general idea that if you abuse monetary fiscal policy, you're really reducing your options, and faced with the risk of bankruptcy or major recession or big crisis, then they will always do more printing and more debt. So I think that's my base case. And yeah, because the way it's measured and what's being displaced is not a real reflection of the real temperature in the water and how it's increasing in different pockets. I think it's just part of the game they play. They're going to try to make us all believe that inflation is under control and that it's no real issue, when I think in reality, we've proven that every time there's a problem, they will respond with the same things. And what I'm going to say is pretty obvious, but when inflation is slowing down, it's not like the temperature in the water is going down. It continues to increase, but at a lower pace. So if we were frogs at 50 degrees and now it's 75, it went up really fast, and the expectations is that we're going to boil literally. And now it's, when inflation slows down, it's still going up. The temperature of the water is still going up. Let's not fool ourselves like, oh, we're going to go back to pre-pandemic levels of prices. That's not happening. And if we had a crisis big enough that would send that down, the amount of printing that will come will be so huge that you will not see the prices going down. We'll see stagflation, which is exactly the base case that we discussed.
Okay. All right. And we can take a segue now to talk about energy and oil prices, as well as we can link in geopolitics as well, because obviously that's a major part of it. We've seen oil prices recently take a dip. I think they're down to about 68 at the moment. I know that Saudi has reduced its quota at OPEC, and that prices have gone down quite a bit recently. What's your overall views on oil prices and the energy market?
Yeah, I think, look, the framework that I put forward in my book, which is almost 10 years ago, well, the flattening of the energy world, it's intact. What we mean by that is, generally, when you think about energy markets, we tend to think about it in silos. And especially 10 years ago, when together with my good friend and co-author Daniel Lacalle, we wrote the book, people talk about crude oil, then separately about natural gas, then about coal, then about power, then about whatever, emissions or any other markets. The reality is that this is a basic principle of marketing and business. Fall in love with the problem, not the solution, right? And the problem is we need energy to transport ourselves from point A to B in the most reliable, cheaper, environmentally friendly way. A lot of people have fallen in love with the product. A lot of people have fallen in love with oil, thinking that this is it. But the reality is that we can go from point A to B with in many other ways, with LNG on the trains or buses or electric cars or renewables. There's so many things. So I think the thesis of the flattening, which was comparing energy markets a little bit more apples with apples, you think you look at crude oil and even at $70 a barrel is still dramatically more expensive than other sources like natural gas. Being a gas is more regional, it's harder to transport because it's a gas. You need to build the pipelines or you need to do these methaneers, which you take the gas and liquefy it. And these are major investments. But once they take place, they give a lot of optionality for gas to move around. But in the US, with LNG, with natural gas prices onshore, let's say $2, $3 an MMBTU, that means nothing to anyone listening, but it's 12 to $18 a barrel of oil equivalent. So the reality is that domestically in the US, you could feed your trains with natural gas at a fraction of the cost of, let's say, diesel or other forms in which they used to run. So I think this is good news in the sense that at the end of the day, in this inflationary battle and pressures, energy is at the core of everything we do, every industrial process and how we move around the world, etc. And having, let's say, a flatter world with more supply, more optionality, fewer spikes, and I think it's a positive for the world as a whole. It has been one of the primary reasons, in my view, why the US has had a competitive advantage to Europe and Asia for the last 15, 20 years. It's been this dramatic change that from shale gas and other things that have given the US much lower natural gas and electricity prices. The war in Europe, Ukraine, Russia has only made that problem worse, with factories having to close down, it becoming very competitive. So energy is really at the core. In the short, medium term, some of these imbalances are very difficult to solve. In the longer term, there's no shortage of hydrocarbons. There's amazing technology developments, renewable, solar, wind, and others are real, and that's pushing the boundaries into batteries and our ability to store power. And so crude oil is being challenged as their monopoly on transportation fuels has been challenged. It's no longer a monopoly. And I think that's, again, there are scenarios and risks where crude oil in the short term could spike significantly, but I think OPEC has learned its lessons as well. They've done incredibly well keeping the physical market tight to create backwardation, which keeps spot prices above futures and prevents some of the entrance from other type of technologies, whether it's Canadian oil sands or ultra deep in Brazil or whatever. But these things keep moving. There are more than just price drivers. There's also energy security drivers. We need the molecules. Not just at the price. And so that investment and overinvestment to make sure that we can get those molecules if needed from places Russia may not be available, and price becomes almost secondary sometimes. So those investments in capacity eventually result in lower long-term energy prices, which is good news, both in terms of molecules available as well as prices. And that is a factor that in some ways counteracts some of the earlier discussion in inflation relative to money being printed. So I think the energy markets will continue to see volatility and divergence. A scenario of geopolitics could be explosive on the upside, but at the same time, technology is relentless, and some of the investments in energy security are as well, and they will result in more supply and lower volatility in the long term. Remember, energy security is a double-edged sword. We in the West, you're in Korea, I'm in Spain, we're obviously consumers and importers. So for us, energy security is all about getting reliable supply. But if you are an energy producer, energy security means can I get reliable demand? And that it's also very important. And I think some of these countries, it's that double-edged sword of how do we secure that supply, but also how do they secure that demand. And I think this investment on both sides eventually leads to some degree of overcapacity and flexibility in the system by having additional pipelines, additional production, even if they might happen at higher prices, higher marginal prices. I think that capacity is there. So the long-term picture for energy is, I think, a flatter world with more diverse and ample sources. But in the short term, it remains a weapon and a critical geopolitical weapon and a key driver of global growth. So it's a fascinating area to keep a close eye on.
So you mentioned that a lot of it's flattening out because of the alternate energy that's available instead of crude oil. Obviously, a lot of the probably reason why crude oil prices have gone down is the weakness in the Chinese economy at the moment and the potential threats for recessions elsewhere, which might reduce power energy usage. How can you quantify how much of that is it's shifting towards alternate energy and how much of that is because of factors to do with the economy?
There's also, when you think about prices, crude oil or others, we all look at the spot price, and that's quite volatile. Long-term prices are way more stable. They're more anchored. And so a lot of the volatility in the short term, it's driven by just pure speculation and both sides. You might have CTAs buying oil aggressively because the trend was higher and then things change and they sell. So the impact from some of these things tend to magnify the impact of news and whatever. We always try to rationalize the action, but there's tons of factors. So I do think that, of course, we can justify oil prices being lower on a number of factors, including expectations of recession and growth in China and the stocking and whatever other factors we can look at. But look, there's just inherent volatility from also other factors, including specs. When it comes down to the impact, I think these things are a bit like what I called in the book, the BTU that broke OPEC's back. You get to see these things building up slowly over the medium long term. Someone like OPEC, who wants to effectively keep their prices higher than artificially high by withholding some of that production capacity, by effectively making the inventories tighter, they succeed for a while. But then as the other production might come in, you need to basically tighten and tighten your production more and more. And eventually, if you think about the revenues from these governments, it's proportional to their production, right? So if Saudi has the ability to produce, for the sake of argument, 12 and they're at 10, and other incremental sources of crude means that in order to keep things stable, they need to go to 8 or 6 or 4 or 2, as it happened in the 80s after the 90s. Eventually, you realize that all those high prices that you kept by cutting yourself have been helping others produce more. And that's when they open the taps, they go back to 10, 12, they flash the market, everyone else collapses, you get back to $10 oil. And that's part of the game. These things are happening. And that's why I think OPEC's being quite smart by tightening the front and keeping the curve in backwardation and preventing some of that entrance. But even with the back end being lower than spot, which prevents in some ways and deters some of the entry from other oil producers is still dramatically higher than nat gas or other forms of energy which are coming in. So I think that shift to electric cars and other things is relentless, and eventually should result in some sort of uh, not quite convergence, but certainly flattening forces that lead to that. So whether we converge and meet at the higher end or the lower end or the middle, time will tell. But you have those forces. My sense is, if you add crisis, then you get closer to the bottom end. If you have geopolitics, it can spike on the upside. But yeah, that's how you keep track of these things. Is once you shift your trains from diesel to LNG, that's it. You're not switching them back easily, or your buses or other forms of stuff. So this demand, or your cars, this demand is steadily, you can track. And again, this BTUs eventually break OPEX back, I think.
Yeah, takes some time to shift. All right. And back to anti-bubbles. How can people set up their portfolio with the anti-bubble kind of strategy in place? What are the components of setting up that type of portfolio?
Yeah. So what we do, my business at Quadriga is historically been on building those defenders and goalkeepers in the portfolio. It's about how do you generate reliable, reactive, convex, asymmetric protection with the lowest possible cost and carry. So I have a hexagon of factors where there's trade-offs between them. If you want something that is extremely reactive and reliable, it must cost you more, or it has lower carry. And so you want to build these portfolios, in our case, multi-asset, multi-maturity, multi-payoff, multi-functional, multi-strike, that work as a team, that build that stuff. The individual components will be things like the put options, fixed call options, gold, oil, dollar, duration, fixed income. But there's so many dimensions. Even if people listening to us say, okay, I want to spend some money in S&P puts, then the question starts to be, okay, so what maturity? Are you going to do 1 month rolling? Are you going to do 3 months, 6 months, 1 year, 2 year? Are you going to do at the money puts, or are you going to do out of the money? If you do at the money, you want it in a vanilla put, or you want put spread, or either way, I think people should be doing protection in option format. The beauty of options is that if you buy the option, you can sleep at night because you know exactly what your worst case scenario is. I've seen a lot of horror stories and people trying to hedge linearly by selling futures or selling options. I very strongly advise against any kind of positions that have open-ended risk that could potentially lose you infinity. I know it sounds unlikely, but these things will eventually, take you out. And so buying options would be my advice. Buying options in things that will be reliable, reactive, convex. There's going to be arguably a cost associated with that, and a carry is the cost of insurance. But there are opportunities over time where you actually get paid for buying insurance, and the risk premium side of things and things that we understand and do. Now, you could decide when you build that team, or you could do it yourself, or you could delegate to someone like us and say, okay, what would you buy? So you're delegating to us the what to buy. But I think that still leaves you with two key major decisions, which is how much and when. And we've seen the how much and when be a big problem. People tend to panic in the middle of a crisis and buy the insurance when it's expensive, and then they stay in that program for a few months or years. Eventually, the emotional distress is so large that they throw the towel and say, "Look, forget it. I'm not protecting myself anymore. It's a waste of money." And obviously, the next crisis comes, and so on and so forth. So, what's critical here is that you think about the bubbles and anti-bubbles, the equity and the protection as part of a team, just like you have strikers, midfielders, defenders, or a car has the engine and the brakes on the driver. There are fundamental pieces that are critical, but it's not just about the what to buy, it's how much and when. And so we have a strategy called Aqua. Aqua usage is even available in platforms like Interactive Brokers and others that effectively it does this thing. It plays its long equity, it adds the option program, and then it automatically accumulates and monetizes the benefits. If you don't do that, if you simply buy your equity and your protection and you don't monetize your protection, like during COVID, for example, our strategies made hundreds of millions of dollars, right? That money is there for you to take and monetize and buy distressed assets. If you are like the deer in the headlights, completely frozen and like very happy that you had that protection because you're still alive as equities collapse, but you don't monetize it, you're completely missing out on the idea of the whole idea of having protections to monetize it and accumulate. And that's why you need a process. And so a lot of people fail to implement this process either because they don't buy the right things or they buy the wrong things or they buy the wrong size at the wrong time. So our effort is to combine the what we call upside alpha, your assets like equities that do well in a benign market, with the downside alpha, which are the defensive assets, and then the rebalancing alpha, which is how do you monetize and accumulate what's cheap and expensive. And sometimes you buy equities and sometimes you sell equities. Sometimes you buy insurance and sometimes you sell it or that protection. And I think that's the way I would recommend more retail and private investors approach. So instead of having your ETF long only equity that is effectively unprotected, they buy protected rebalanced equity, which is what we do with the Quadriga Aqua strategy. So if anybody wants to learn more about this, feel free to contact me directly through Twitter or LinkedIn or whatever, and we give this information. I think the emotionally, behaviorally, operationally, the best way. Think about what happened in August. The move was so fast with the dollar yen and the Nikkei that in that move, within 24 hours, we were effectively monetizing the VIX and buying equities. If you had the pieces separately, you would need to sell and settle and instruct and buy. So I think having everything in one single line item, it's significantly more efficient for pretty much all the retail and private investors. The professional investors would still favor the separate pieces, and you can create a team with Morgan, but that's a full-time job. But that's how I think you play it. You build the bubble anti-bubble. Not that they're bubbles and anti-bubbles in the sense that you want to buy things that are artificially expensive. I'm referring more about teams that display bubble anti-bubble dynamics. And you know that when things are expensive, they're on the other side, they're very cheap. And so your team is always going to be much more balanced. That's how I would recommend to people do this. And again, you can do it on your own, or you can effectively team up and partner up with people like us.
Yeah, that makes a lot of sense. And you're basically buying the umbrella before it rains, right?
Yeah. And I think there's also general misconception with respect to hedging, as in the sense that we're all wired to be long. It's very natural to be long equities, right? And so buying protection always feels strange, right? It's like you live in this place where there's always nice weather and occasionally it rains, but it's a fundamental part of the weather. But sometimes it'll be sunny, sometimes it'll rain, sometimes. But you want to be, for me, it's more about the teamwork. And that's why I use a lot of sporting analogies. A portfolio is like a sports team. And anybody that is listening who's ever played any sports knows that sports is about offense and defense, right? It's about attack and defense. And you need the strikers that score the goals. You need the engine of the car that makes you go fast. But you also need the brakes that allow you to slow down in the corners or avoid an accident. And there's so many portfolios that are long only engine, portfolios that are long only strikers. And as a result, they completely crash in every accident, in many corners. And it's not intuitive that adding something to your portfolio, like a goalkeeper or brakes, is really non-intuitive. That adding something that slows you down will allow you to go faster and safer. And that's really the non-linearity of portfolio construction. And that is, I've written this paper called Upside Alpha, Downside Alpha, Rebalancing Alpha. And I explained that non-linearity of how adding things like insurance that on a standalone basis may not look great, on an incremental basis are actually risk reducing and return enhancement. And that is, I think, a fundamental concept that people should learn about in terms of portfolio construction. It's not about the individual players, it's how they work as a team. So if anybody likes football, and I know in Korea they do, and in the UK and Spain as well, we speak a lot of football. But if Lionel Messi was the best footballer in the world, some people might conclude that a team with 11 Lionel Messis would be world champion. I would much rather have 10 Lionel Messis and a Thibaut Courtois, the Real Madrid goalkeeper, than Messi on goal. So it's about what positions do you have in your portfolio and who are the right players to fill that role. But there's so many people that just ignore correlations and build portfolios purely based on individual behavior. And this leads to gross underperformance. In fact, I would argue the team is worse than some of the individual pieces because of this dynamic. So it's really about portfolio teamwork, what the bubble anti-bubble framework does, embracing that volatility and compound through enhanced capital preservation and discipline accumulation and monetization.
Perfect analogy. Last question is, if people want to find out more about you, Diego, how can they reach you and find out more?
Feel free to reach out directly through perhaps Twitter, X, Parrilla, Diego, RRL, our website at Quadriga Asset Managers in Madrid. Or you can think we produce monthly newsletters, and our strategies are widely available through a lot of the main investment platforms and banks. I enjoy this kind of discussions. It's always, even if we might be looking at similar things, there's always unique new ideas that come out from all these discussions. So we encourage people to also look into perhaps other past discussions or articles or pieces. But do feel free to reach out. We'll be very happy to share some of our experience and hopefully build a partnership as we try to become an extension of their team.
Perfect. Thank you very much for the discussion today, Diego. I've really enjoyed it. I think the audience is going to get a lot from the discussion that we've had today. We'd love for you to come back onto the show later on as things change as well and have another discussion with you. That would be really great. But I've really enjoyed our discussion today. Thank you.
Likewise, Steve, thank you so much. All the best in the podcast. Great initiative. And I think everything we do to effectively educate people in finance and investments is time well spent. So thank you for the invitation. Keep the great work and good luck, everyone.